This is Robbie Cannon, President and CEO of Horizon Investments, with a special report based off market activity over the last week of trading days. I wanted to bring some information to your attention, not only in terms of strategy, but also in terms of market dynamics, so that you'll be educated in light of maybe customer calls or maybe questions that you have. So let's get started in terms of the markets as it relates to the last market sell-off or market decline in February during the first quarter. Some of the interesting things about this market, very different from February in terms of what triggered them. Triggers are always different. The feeling is always the same. And the feeling sometimes can be an air pocket. And so the market, in regards to institutional selling, can force markets down in very large increments. And we saw that yesterday in regards to October 24th. In regards to February, we had a couple things taking place that I want to draw your attention to. Not the least of which is not only the decline, but the sharpness and the quickness of the decline. In February, the market activity occurred over about a 10-day trading period, where this one in October is more like 22 days, a very slow downward grind. The feeling, though, is even more interesting as you look at the asymmetry of market up versus down days in relation to the last few volatility type events. So if you go back to 2015, or even you go back to February of this year, what you notice is both up and down days are more symmetric. So you can have very fast-moving down days, but you will also have very fast-moving up days in a symmetric fashion. This time around has felt different, and look at the asymmetry that has occurred. In fact, in October, there's only been 5 days where the market's been up. In fact, we're in October 25th right now. The market, as it sits right this second, is actually up as well. So there'll be 6 days in October. But the vast majority of days have been down, and that is different. We do not expect this asymmetry to continue. One of the questions you might ask yourself is, was there a place to hide? And I would say this one is an interesting slide in that while it started with U.S. markets in terms of a few trading days ago, it actually radiated out into pretty much every piece of U.S. and international markets. But what we're showing you on the left-hand side is both the style box, value and growth, and also capitalization from small to large. And what you'd notice is if you're mid-cap centric, maybe you could hide in large cap. If you're a small cap, maybe you could hide in mid-cap. Or if you're a value, maybe move to growth or vice versa. In this type of market environment, there really was nowhere to hide. If you go from the style box to geography, what you'd also find is whether you're in U.S. markets, developed, international, like IFA, or emerging markets, again, the market declines persisted across the landscape. And so it was one of these events where it really didn't matter how you were positioned. You would have lost maybe a little less, and maybe a little bit more in small cap, for example, or a little bit more in emerging, but you still wouldn't have avoided the downturn. In terms of the overarching fundamentals of the market, the fundamentals have never looked stronger. So even in the backdrop of the market activity that's persisted over the last 22 days in regards to October, the fundamentals have never looked stronger. So whether you're talking about corporate earnings, GDP growth, inflation, low interest rates, no matter where you look from a 90,000-foot perspective, the market really does look strong in a lot of areas. That's to say, so where's the conversation? The risk conversation in February, as you'll recall, was right around the VIX itself and a sharp spike in VIX, and also institutional managed vol strategies that ended up being forced to sell or forced to rebalance in that market event. This market event is different in that there's a lot of uncertainty and there's a lot of different pieces that take place to make up this mosaic that is trying to be solved by the market, not the least of which is interest rates. So interest rates have creeped up, and what you've noticed in the sell-off is as they've come down is that also market expectations for additional hikes have come down as well. So while there might be some tension in regards to interest rates, we don't think that's the epicenter. There has also been selling in regards to managed vol strategies, but certainly not the epicenter that it was also in February. How about China and the global dynamics that have occurred with tariffs? Certainly, this is a stress on the market and on growth itself. We would assume that maybe it shaves off tenths of a percent of GDP, but certainly not the epicenter of a very large bear market type sell-off. Well, what about corporate earnings? We're in the middle of earnings season, and in fact, earnings forward guidance has come down. Is that a problem? It's a problem in so much as that we're at all-time highs on corporate earnings. Coming down a little bit is actually a more sustainable path, and we certainly don't see corporate earnings going negative. One of the things we do see, which we like a lot, is CapEx. CapEx is at all-time highs, and that means that companies are investing in their futures because the business climate is stable enough for them to do that. So what is exactly the epicenter of the sell-off? Unfortunately, you can't always know what the one snowflake is that causes maybe some eruption, but what we would say is that we're watching it. In terms of how we act at Horizon, just to give you a little behind the scenes and open the curtain a little bit. So we've got a great team of professionals that meet on a weekly basis. So we start with a macro meeting, talking about macro markets, talking about international and US and fixed income markets and institutional dynamics like currencies. Then we move into the actual positioning of the portfolio, where we're actually talking about specific ETFs or sectors or countries that we might buy or maybe watch. That's occurring on a weekly basis, but on a daily basis, this group of professionals is continually talking about market activity. And we're not constrained by some sort of calendar rebalance, for example. We're actively managing these strategies in times like this. And we've very much cherished our advisor base because this is why you trust us. I want to reach out to a couple of our strategies and now talk specifically about how they're impacted by this market movement and by the activity that's occurred over the last few trading days. First and foremost, I want to announce, and I'm really excited about this, that Risk Assist is activated. And so it's on. And many of you have asked the question, when is it going to turn on? And it's on now. And in fact, if you can go to the pro site, you can see the actual de-risking in the strategies that's relevant to you and your clients. What from a leadership standpoint, one of the hallmarks of what I wanted to create with Risk Assist is a dynamic that could be transparent. And in regards to our technology, I've made that available to you. That was something very important that I did as we created this strategy and as we launched this Protect Suite. In regards of expectations, we've got a lot of customers spread out over accumulation, preservation, and distribution. So whether you're in our gain, whether you're in our protect, or whether you're in our spend portfolios, there are certainly expectations that all of our clients need to keep in mind as markets move, whether up, down, or sideways. In regards to Risk Assist, what's very important right now is that you log into the pro site. And if you're not, please contact our sales desk. We'd be happy to get you a login so that you can see what the different levels of the de-risking are for the various strategies. For up markets, you've seen that in 2017. You also saw that most of this year, is that Risk Assist stays out of the way. It's not for those small losses as you're sitting across from a client and he needs to invest to achieve a goal. It's for the big loss. It's for the catastrophic loss that this client and your client base have worked so hard to earn this wealth, and now to put it at risk they simply need some answers. And so that's what Risk Assist provides them. In regard to real spend, the same type of expectations can be set, that in up markets, you can expect market results from the portfolios at the various risk levels that you find yourselves in. But in down markets, just know that there's several mechanisms. There's a defense in depth taking place, not only in regards to the diversification of the portfolio itself, and also in regards to the risk mechanism that we use for mitigation, but also in regards to the 3 years of spending reserve that we hold out. And so this structure itself provides the protection for your retirement income clients. So it's not any one thing that we're looking at. We talked a little bit about the market activity, how it was different from February. We then talked about the specifics in regards to the market dynamics and what we were looking at. I also wanted to handle a couple of questions before we ended. So as we think about the expectations of those various strategies, a couple of questions that come to mind. When will the selling pressure release or abate? And I would just say that we expect increased volatility through the midterm elections. But in regards to the actual floor of the market, one of the important levels that we're looking at is the February lows in the 2550 range. And we believe that actually is a good level to hold. Right now, the market in very precise increments is looking to hold some stability in these kind of downturns. So 2700, 2600, 2650, those kind of even numbers become very important to algorithmic buying and selling. And so you'll notice that the market will trend or flatten out around those specific levels. In regards to the activity that Horizon seeks to engage in over the next several weeks, even as we look at this market activity, we will continue to do, as usual, our normal investment committee schedule on a weekly basis and meet as a group to continually talk about and discuss the markets and the market activity that we're in. In regards to where we see the rest of the fourth quarter, we do think that because of the speed of this sell-off, it is more likely that the market ends higher at the end of December. So yes, October, we had a great third quarter, then a very poor trading October. What we would expect is that we would move into the fourth quarter towards the end of it with strength. That said, I very much appreciate being in front of all our advisors and clients. We cherish you, and we expect to be in front of you in these type of conditions. We actually communicate more, not less, in times of stress to make the business and the professionals more transparent, and the ideas and the thoughts behind the ideas more accessible to you. So again, thank you very much for your time, and we look forward to talking with you again.